and specific to what makes Glacier slightly unique compared to the others. And I've kind of done it in a way that, like, if I was an intermediary, I would use Glacier because of these specific reasons. But to start off, and like, it's usually the biggest consideration when it comes to intermediaries, and specifically with Glacier as well, because there's this perception that Glacier is kind of the most expensive of the bigger platforms. And I thought I'd actually put numbers to that. So what this graph shows you is us compared to our three largest competitors and the admin fees across various amounts for the different platforms. So you can see, if you look at this graph, if the line is below the other lines, it means that it's cheaper. If it's above, it means that it's more expensive. And this is just admin fees specifically. So from an admin fee perspective, the first big takeout is that we're not the most expensive, but neither are we the cheapest. You can see there's one competitor there that's pretty much the cheapest for amounts up till 1.75 million. I'm actually not allowed to say the competitors' names, but you can pretty much guess who they are. But when I was doing this, a very interesting thing came across my mind, because I was doing this exercise specifically for an intermediary that was appalled at how expensive we are compared to platforms. And I decided to kind of look at the actual quantum that this person was talking about, because in her words, her value proposition is built around providing the most cost-effective solution for her clients, and that to her solely meant picking the cheapest admin fee from all the platforms. And if you look at the cost difference, the biggest saving you can make admin fee 60 Rand per annum cost saving on every 100,000. And that's only up till about 250. So the biggest cost saving is that 0.06% equates to on every 100,000 Rand per annum. Now, I'm not going to say that that's an insignificant amount, because that would be kind of arrogant. But if my value position is built around cost savings, I would actually want to do a little more for my clients than 60 Rand per annum. The fact that on average advisor fees are 0.5%. If your value proposition is built on cost savings, it doesn't really make sense to charge your client 5,000 Rand to save them 60 Rand. So I started thinking about it. Where is the biggest cost when it comes to clients? From an investment perspective, where does the bulk of the fees go? And the obvious answer is that it's investment management fees, because while admin fees are 0.5 sliding downwards and advice fees in general are 0.5%, investment management fees can be 1.5, 2.5, 2.4. So from an investment management perspective, those fees are where the client is paying the most amount. And if I was going to build my value proposition solely around fee reduction, then I'd want to use as cost-effective funds as possible. So from a Glacier perspective, we've got a wide range of passive options, obviously clean price funds, but all platforms, all major platforms, clean price funds. But we've taken a step further and actually added on ETFs to the platform. So essentially, we can give you the cheapest passive option, or the cheapest index tracking option is available on a platform. And the example of include things like style-related ETFs. So if you want a collection of the momentum focused in or momentum stocks focused in an index, we've got that available. There's even ESG-focused ETFs like the diversity and inclusion ETF. So I'm somebody that's focusing purely on cost. Then logically, I should be either using this as the main option in my at least a significant portion of my investment strategy, because here I can bring down costs anywhere from 0.6%. And these are available on most of the DFMs that are out there. So the larger DFMs, if you're using them, integrate these into your portfolio as well to make a significant difference when it comes to costs. So here it's Glacier kind of adding value in a way that's going beyond that 60 Rand per annum from a cost perspective. So
just interesting sake show, and you said you know, it's not a question, but all right, the first one is maybe a question just on the cost. You don't have to go back to the slide where you showed the four or so with the three competitors. Is that the average cost? So when you go over the fee, it gives you the average with the first, because all the cost works on a scale table. So that I guess is on average when it goes down.
Yeah, so it's basically it's set up exactly like if you investing 1.25 million, you would be
where a lot of people make the mistake is that you can have a fund with management fees of 1.5, but that fund is performing better than a particular index fund with a cost of 0.5% over the past 10 years, you know, then suddenly cost is not a factor anymore. So people be very careful just to only cost, but it is an important point to take as part of your consideration.
That. I mean, and people don't spend enough time looking at the important part. I mean, to my mind, using investment to generate return, whether you're using an RA or whether you're using a living annuity, it's that return that's the important part. But the thing is, the return is actually not a controllable factor, because investment management is not generating returns. It's actually managing risk, because that's something that you actually can manage. You can't actually manage returns. You don't know what the circumstances are going to be next year. So way, you know, like it's like you're hitting all the right points, and how sophisticated your investment strategy is with the tire. It's not like picking the cheapest fee. To fund section, 940 different unit trusts available on the platform, and here the range is to do managed share portfolios. We've recently opened up hedge funds that are available planners the correct categories on. We've got the longest running artificial intelligence in South Africa. We actually brought it over from that manages funds. Basically, it's managed allocation across different ETFs, and it's done purely we've got all the major wrap fund managers on the platform, ETFs and index trackers. So essentially, the toolbox to make as sophisticated investment strategy or portfolio construction as possible, and real value on it. And just to give you an example from a fund basis, in partnership with a discretionary fund manager, Glacier Invest, there's these large funds that we use to manage living annuity book. It started off with the majority of it being with the tied agency force. So essentially what the purpose was to create a living annuity solution that would be best in the industry that our tied agents could use. And what happened over time was, with the basis of your normal kind of portfolio construction and your normal kind of management, but we started to add on different material in terms of the return profile. So they wanted a living annuity solution that could give you the same kind of moderate or a moderate aggressive will give you, with a risk profile that's vastly different. That's where that asymmetry part comes in. So I want to keep the returns and consistency of market-related assets, but I want to significantly reduce the risk. Being in the past year, in the 10 years now, we've got unprecedented volatility, and that volatility is severely affecting our living annuity clients. So much so that it's creating situations where they need to take high draws, but the markets are not giving them that kind of returns to bolster those high draws in the past. So what the chief investment officer did was, he started introducing new or different kinds of strategies and funds to see if he could make a material difference on the risk. And as it stands, he's using hedge funds, he's using smooth bonus funds, and he's using alternate assets to create a risk profile that's very different from everything else. And the outcome of it is what we call our Glacier Invest income solution range. So this is 5 funds that's got your normal kind of portfolio construction, with the addition of smooth bonus funds and hedge funds and alternate assets to significantly reduce the risk in it. So each of the 5 funds kind of corresponds with a risk profile. So your 2.5% corresponds with a conservative profile, and your 6% real income solution conforms to aggressive profile. The thing with these funds is that the return profile corresponds with it, not the risk profile. So to give you an example, the 5% real income, which on a normal basis would conform to your ICISA high equity category, so that's your category, in terms of assets that because they use the bonus fund and alternate assets, that the risk is significantly different from every high equity fund. And the beauty part of it is it's not compromising on the return profile. In fact, it's got a return profile that's even higher than your average high equity fund. So basically, these kind of funds and using those alternate funds and alternate assets, it's doing. I'm passionate about this kind of solution for the main reason that you see value here, because these pensioners, I mean, it's been a rough game for them. And this is something that's actually a real kind of difference. I mean, if you look at this long-term growth chart, it's the 5% real income versus the high equity and the all share index. Because of that risk management, you are ending up with more consistency in returns and better outcomes in returns. Because when the dips hit, it's not going to be as severe as if you are fully invested in the traditional asset classes. So this kind of solution, it's there, that consistency that really makes a material difference when it's a client that's taking a drawdown. And at Glacier, these are the kind of things that we spend all our time on, because majority of our business is the retirement space. I mean, majority of our book is a living annuity book, and our basic theme is that we're retirement obsessed. So product development, Glacier Research, Glacier Invest, and the sales and distribution team, we are always trying to look at ways to solve that retirement conundrum. And like I just pulled the latest stats or the latest performance stats for these funds, and you can see, whereas most of the other funds in that category didn't manage to preserve capital, these funds did. So it's not great numbers, because that's what the markets were in 2022, but it at least managed to preserve capital for our pensioner members that are in these funds. So the question always comes, what kind of service can I expect from Glacier? And I'll be honest with you, I wouldn't think that there'd be a very big difference from a service perspective between us and the other major competitors out there. Because, I mean, simply, if you're a big enough business, you can put resources and money into putting the right people in places, putting the right IT infrastructure. But the way I see Glacier's service support as different from the others is that we place a tremendous amount of focus on assisting from a planning perspective. So my team in particular, our value proposition is providing planning support. And to give you an example of how we do this, I mentioned us being retirement obsessed. And the thing is, the retirement industry, it's a very, very harsh place out there. The biggest problem is that there's only 6% of employed South Africans at the moment that can actually retire with some semblance of the same lifestyle that they had previously. People that are retired, majority don't have savings. The average drawdown rate is 7 and climbing. And some of the scary stuff is that retirees are supporting adult dependence. You know, unemployment rates in our country are making it such that there's a sandwich generation that's now supporting on both ends. So retirement is, as I said, it's something that we obsessed over, and it's something that we've actually put a lot of thought into over the years. And the Glacier Invest Real Income Solutions was one of them. But another big solution that we've come across, and it's purely a planning thing, because you'll see that it's actually, we're not really using any new products or anything. We're just using what's available. But essentially, majority of retirees have the issue that if I'm taking a 7% drawdown, and if markets aren't really giving me the right kind of returns that can supplement a relatively high drawdown, then from the get-go, I'm not going to be beating inflation in any real way. And my capital is also going to be depleting over time. And 9 times out of 10, markets used to just go 100% into the living annuity. Why? Because you've got those benefits of flexibility. You've got market returns that can bolster your value, and people want to leave a legacy. It's, as I said, a consequence of the country that we live in, but adult dependency is a reality for quite a few people. But the thing is, if I want to leave a legacy, and if I'm one of the people that has a 50% chance to make it to the age of 96, then I'm going to be fighting a losing battle. And it's going to come to a situation where I had this intention to leave money for my kids, but all that happens is my income's going to dwindle down and my capital is going to dwindle down, and then all my kids are going to inherit is just medical bills. So we looked at ways in which the market can kind of help the situation, and that's where the Glacier Invest Real Income Solutions were born. But from a planning perspective, from a product perspective, there's also another way to kind of solve this issue. And that's using a combination of guaranteed annuities and living annuities. So the combo product, it puts clients in a better off situation instantly. So what this graph shows you is the blue lines are the income of just going 100% into the living annuity. The pink and purple lines is the combination of using 2/3 in a living annuity and 1/3 in a life annuity. And as you can see, from the get-go, the client's in a better off situation. And I like this because it's not that the client needs more money to put them in a better situation. It's using the same money, it's just using it from a more planning efficient perspective. And the obvious question comes through, well, there's two answers to that. The first is that there is guaranteed products that that's available via Sunlum. And if you are using your guaranteed annuity that's doing the heavy lifting over time, then that takes pressure off your living annuity, meaning that I can drop the living annuity drawdown rate to something that's more manageable and something that can provide growth in my capital. So if I continue with the same path, same returns for both cases, but the combo annuity can actually end up with more capital at the end of the road than just going 100% on the living annuity. So using a combination can actually put you off in a better situation when it comes to the legacy. And how we support planners to get to these kind of scenarios is that we give you the retirement income planning tools available straight on the platform. So if you go to Investment Hub and you want to draw a report with these graphs showing the client the journey in terms of their income, in terms of the capital, and showing the client in rand terms what kind of income they can expect. Like this is the rand term difference between that example. You can see after 15 years, the client's getting 31,000 Rand per month instead of 22. After 30 years, the client's getting 56,000 Rand per month instead of 29. This is available to you if you use the platform. It's totally free. It's an easy data capturing exercise. You use sliders to show the difference between using different combinations. And you can the full life annuities. You need specialist support, give me a shout, and then we can have a discussion around it. The smooth bonus funds, cost-effective solutions, the real income solutions. And I think using all of these things that are available can put our clients in the best situation as possible. In fact, what's been happening a lot last year is that people are looking into their living annuity books, identifying the clients that are getting themselves into trouble, and doing a split on an existing living annuity. So we've got that option available as well, but that's actually been putting clients in a more sustainable income situation. And sometimes even the client ends up with getting more income than they normally would if they just stayed in the living annuity. And the main reason for that is that guaranteed rates are quite favorable at the moment. How long they're going to stay that way is a big question, but it's been working quite well for quite a few clients of ours. The other way in which we provide specialist support from a planning perspective is that we have a dedicated public sector division. So here we've got a business development manager that acts as the specialist for anything related to public sector, not just GEPF, but also SOE funds, so Transnet, Eskom, SAA, PRASA, Telkom, SABC, municipality funds. The size of the public sector is actually massive. You're looking at about 1.27 active members across 2 trillion market value assets. And I used to get the argument sometimes that like, oh, I don't really work in the public sector space because most of my clients are more high net worth or more professional clients. But the truth of the matter is on average, a public sector salary is double a private sector salary. And public sector has engineers and doctors and other professions. So I think this is it's a very large market. If you're not in that space, there's a very high probability that you do have clients in the space. And if you need assistance on that, because the unfortunate truth, especially with the SOE funds as well, is that there's a lot of retrenchments happening out there and a lot of people that really need good advice when it comes to those retrenchments, because you see it quite often when they don't get proper advice, they do end up making decisions for that retrenchment money that severely affects them for the rest of their lives. So this is available. We've got special collateral for it, proposal tools, tax simulations, and we can assist with all the more complicated administrative stuff, especially with the GEPF, because it has its own processes and things like that. We've got the expertise, experience, and backup that will help you make sure that you can become an expert in the space if you choose to. Just in terms of product innovations, the type of product stuff that makes us slightly different from our competitors. We've got a very comprehensive option in terms of offshore investments. So here it's where clients want to externalize their investment in a real way, meaning that they want an investment that's going to be denominated in a foreign policy, or in foreign currency, sorry. Here, majority of the time, it is the higher tax bracket people that would probably have estate considerations. So more often than not, for those kind of clients, I highly recommend using the global life plan endowment policy, for the main reason that it's tax efficient. So you only pay 12% CGT on it because these offshore funds are all roll-up funds. So there's only capital gains in it. But the main thing is the estate planning benefits. You don't have to worry about situs. You put a beneficiary on it. If you pass away, even if your beneficiary lives in the UK or Australia or wherever it is, there's a seamless transfer of the money across. It's still estate dutiable, but you're not going to pay estate duty state and situs tax. So that's also something that's been extremely popular in the past few years. And the other thing that we've noticed is that the type of clients that are looking at externalizing money, that market is changing. So in order to adjust with that market, we've released a LISP option for an offshore plan. Here, instead of a $25,000 euro or pound minimum, you can get in with 100,000 lump sum or 10,000 Rand per month recurring. It's not wrapped, but it's something that you can use to build up until you get to that point where you can get into the wrapper. It's extremely popular with the those clients that go and work in Dubai as a nurse for a few years, or go and teach in the UAE for a few years, because they end up getting quite a lot of money and they want to look at something where they can keep it in a foreign currency. It's also very popular with older clients that have kids that have immigrated, and they want to find a way to kind of efficiently move wealth for their kids that have immigrated already. But as I said, this has been extremely popular in the last few years. The uncertainty in global markets last year did push it back a bit, but I always say that's really the time that you should be getting into stuff, you know, like at the bottom of the market, not the top. But yeah, that's just my personal opinion.
That's
But here again,
that's precisely what I said to two clients this morning. You know, we tend to, when there's a sale at the malls, we markets, it seems like we're running away.
That's exactly it. Like I even remember using that exact same like analogy. It's like, no, it's a sale. Like, don't see negative return. See, like, this is 40% less than what last. But yeah, that's exactly the point. And just another one, I wanted to just touch on this briefly because it just gives you an example of the kind of innovative products that we kind of look at from a Glacier perspective. This is the Glacier Sustainable World Enhancer. So what this is, it's a structured note within a sinking policy. So the good thing with a structured note is that you can create terms and conditions and benefits that you wouldn't normally be able to put into a standard investment. And the benefits of this kind of structure is that we can give you 100% capital protection. It's an actual on-paper guarantee that's guaranteed by an international bank. The bank that we use in this structured note is BNP Paribas. The other benefit is that we can structure return enhancements. So the return enhancement on this particular note is that whatever return that the portfolio that's used in it gives you after a 5-year period, it's multiplied by 4. So basically, you're quadrupling whatever return the portfolio is going to give you. The other benefits of using the structure, especially in a sinking fund, is that from a tax perspective, you only pay CGT. So it's the return, you take out your 12% CGT, and that's what the client's going to get. If I had to think about a downside of the kind of structure, it would obviously be liquidity. You are capable of canceling the product, but more often than not, you'd probably be out of pocket on it because it's built to be a 5-year term product, and the exit clause is going to be market value of the portfolio at that point in time, less costs, and that will get paid to the client. But other than the liquidity benefit, I quite like this product because the portfolio that's used, it's offshore and it's called the Sole Active Sustainable Development Goals Index. So what this basically, or what the portfolio basically is made up of, it's made up of the top 50 scoring companies in the world that have the highest incidence and concentration of ESG factors. So to give you an example, Colgate Palm Olive, one of the main reasons that they're on this list is that they've got this thing called the Brightest Smiles Initiative. And that provides oral health care, free oral health care and oral hygiene products to 1 billion underprivileged children across the world. And most of the others like Eversource Energy, Consolidated Edison Inc., they're at the cutting edge of sustainable energy provision. So if you had to ask my personal opinion on what's going to be the big trend in investments, it actually is, from an international perspective, that's where all the focus is. It's on these kind of companies. And it actually makes sense if you think about it, because if you look at a lot of the woes that we have, a lot of the issues that we have, whether it's from the public sector or the issues that we've had in the private sector, with companies like Tongaat Hewlett and Steinhoff and the like, a lot of it comes from governance failures. And when people think ESG, they tend to almost obsess over the environmental part, but they forget that it also talks about the society benefit and the governance benefit. So it's companies that take ethics to an extremely serious level and also take what they call stakeholder management in an important level. And that means doing right by the communities in which you operate in and looking at the type of people that use your products and doing it in a responsible way. And it makes sense that these are the type of companies that people will want to deal with going forward. And not just going forward, like, I wouldn't want to deal with a company that's not taking these types of things seriously. These businesses while giving me that benefit of protecting my equity. So it's not something that I'd go all in, but this is an excellent, excellent, excellent addition to any savings plan, because I'm getting offshore equity. I'm getting it in a sector that's got a lot of high growth potential value, and I'm getting it that's protecting my capital. This particular tranche, it's taking a bit of time. Normally we open it up. We should have opened it up by the end of Jan, but I think that the product management team is having a relook at some of the aspects around it. But when it does open up, I'll let you know about it. But yeah, as I said, it's a very nice product. I really, 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 really have a lot of faith in the product because it makes a lot of sense to me. From an intermediary fee perspective, it's got only upfront fees, and it's 3% maximum ex VAT, but the fees are structured into the product. So if a client invests 100,000 and you take maximum fees, then the client's 100,000 is capital guaranteed for that 5-year period. And whatever you don't take in fees is added to the client's value. So if you take 1% instead of 3%, the other 2% gets added to the client's value that's invested in the product. And as I said, the big downside is that it's not a product where the client would require any sort of liquidity within the 5 years. Yeah, I think I've covered everything I wanted to. But as I said, it's our open architecture. It's our wide range of solutions that are available, specifically on the fund side. But also the fact that as much as we invest a whole lot into IT systems, we're still cognizant of the fact that it's business. People do business with people. So if you notice, like, every area has a person that you can speak to. So like international, we actually have an international specialist. Public sector, there's a public sector specialist. We even have a specialist for the life wrap stuff. But you don't need to worry about all that complexity. You can always just work through Jono or myself, and we just make sure the right people get to the right stuff. But that's how we add service. That's how we add value. And we want to be a partner within your value proposition. We want to give your value proposition a boost, because you can see all of our stuff, it's focused solely on adding to that planning value proposition.